Welcome back. We're coming to you live from the SALT conference in Las Vegas this morning. We're taking a look at markets right now. Rebounding yesterday from their biggest sell-off in 8 months the day before. Still uncertainty over the administration's policy has some investors on edge. Take a look at markets yesterday, though. Dow Industrials up 0.25%, 56 points higher. Nice rebound there from the day before. Joining us right now, HFR President Ken Heinz and Francis Insight CEO Francis Newton Stacy. Good to see you both. Thank you so much for joining us.
Thanks,
Francis, let's kick it off with you. In terms of these gains that we saw yesterday, and we're expecting it again today, what do you think is going on in the midst of all this volatility?
Well, actually, there was a gap up open on April 24th, 25th. There were 2 gaps up. And so what happened was the market sold off in order to fill those gaps. It was blamed on the Trump administration and all the volatility. And then the market reversed exactly correctly off of the gap and came right back up. So I don't think we're going to see a sell-off yet.
Yeah, so there's still that bit under the market, isn't there, Ken, that, you know, basically hedge funds and money managers are saying, look, unless something goes horribly wrong with the agenda, you still want to own stocks.
Absolutely. I think one of the most exciting things about the current environment in terms of an opportunity for fund managers to make money now in 2017 is really where this implied volatility trade has gone in the last since the French election, right? So it's hit historical lows, and for funds that actually trade volatility as an asset class, when you do see that volatility explode at some point, be it tomorrow, next week, next month, I think there's a great opportunity for macro strategies to make money in that environment.
We haven't seen any volatility in a while.
Right. No, but because there's so much investing based on what is or isn't happening out of our nation's capital, and when you have, I don't even think this is arguable, the most unpredictable president of the United States in terms of how he communicates, you're literally placing bets in part on what is said by the president and what comes out of Washington, which just makes it that much more tricky given the low growth environment.
Well, we've talked a lot in the past about the fact that underlying strength is there. First quarter profits were up 15%, which is pretty good. You know, revenue's up 6%, and you got a stronger than expected dollar. How does that all jive? What do you think, Ken?
Yeah, I think that that right now, as you know, the hedge fund industry is all about finance, and finance is all about politics. Politics is all about Donald Trump right now, and that everything comes back to that in terms of trading the signals that people are focusing on. And yes, I do think that there is underlying strength. I think that people are expecting fundamentally to see interest rates continue to rise and see the positive impact that has on overall market performance.
So what are hedge funds doing right now?
Yeah, I mean, all of the same trades are still very much in place. I mean, people are very focused on the 4 drivers of performance that I think in 2017. You have the sort of oscillating pattern of the wind and unwind associated with the Trump trade, the EU trade and the elections that have been there, the Brexit implementation trade, and the EU trade. So all of those
the EU trade is an important one, right?
Yeah.
I mean, you're seeing money move into Europe in a big way right now. A lot of people talking about Europe. Remember last weekend, the cover of Barron's by Europe. And that's what you're seeing, aren't you, Francis?
Yes, because we're going to actually end up selling the United States at the end of this year. When the Fed raises rates 2 more times and they start to reconcile their balance sheet, they're actually removing money from circulation. So they're actually going to tighten the aggregate money supply, and we will see a sell-off in the fall. And I think buy Europe trade, I don't think the tightening is happening there at the rate that it's happening here.
Still free money in Europe.
That's why, and in terms of the tightening, as you rationalize the balance sheet here by the Federal Reserve, that's why you need to see movement on the fiscal side. That's why it becomes that much more critical. As Stephanie Pomboy has said, no tax reform, no healthcare overhaul, we're getting a recession.
Yeah, she's great. She's going to join us next week. Go ahead, final comment.
The other thing, though, and just to add to that, as you do see you saw the U.S. banks really uptick as U.S. rates started to rise earlier this year. And I think as you see, that right now from a valuation perspective, those European banks are as cheap as they could be anywhere. As you do eventually, be it later this year or next year, start to see higher rates in the U.S., I think there's going to be a lot of opportunity in those banks coming off those really low valuations.
So you want to buy, sometimes banks are at low valuations for a reson. Sometimes they stay at low valuations.
That's
right.
But
you say you want to buy the European banks?
Absolutely.
Okay, great. We'll leave it there. Ken Heinz, Francis Newton Stacy, good to see you both. Thank you so much for your insights.